So I actually wear two hats in the investment space, which is kind of ironic because for 10 years I was a lawyer and I didn't know the first thing about the finance industry. But all this kind of came together in an opportunistic way. So back in 1975, my partner, Rick Slaughter, was a 23 or 24-year-old graduate of San Diego State University in finance. He had done some graduate work at USC and San Diego State and things like artificial intelligence, computer programming, stuff that no one was really thinking about or doing in that time frame. And he launched in 1975 what, by all accounts, is the first hedge fund ever launched in the state of California. And one of the first hedge funds launched, period, anywhere. It was a macro strategy. The goal was to try and invest long and short across multiple markets and multiple geographies and multiple asset classes and give investors a, quote, alternative income stream, an alternative return, something different than they could get at that time. Because at the time, what could you do? You could buy stocks, and you could buy bonds, or you could have cash, or you could buy a house. And that was it. There were no alternatives. That's what alternative investing is all about. And so he was kind of the father of it. Well, spin ahead 20 years later, through some connections in my legal career and some personal connections, I got introduced to this firm. They had a wonderful track record. I put some money with them. I got to know the principals of the firm very well. And then happenstance hit, and their CEO reached out to me in the mid-2000s and said, you know, we're really looking to kind of pivot this business to the next generation. We've gotten to know you. You're a little younger than the founders. Do you have any interest in coming over to finance? And I kind of scratched my head and said, why on earth would I do that? I'm a lawyer. I was in San Francisco. My career was going well. But he planted a bug. And for 2-3 years, I just kept thinking about it. And finally, in 2007, we moved down to San Diego, and I decided to leave the legal career and try this out. So in the early 2008, I joined, I came into the asset management business. And of course, 3 months later, the world collapsed. So why am I still here? Because I love it. I love everything about it. So I love it so much that within 2 years of joining my firm, Sunrise Capital Partners, which I'll describe in a bit, I got together with other hedge fund managers and we formed the California Hedge Fund Association. We did that in the beginning of 2010. What is the California Hedge Fund Association? Basically, it was a bunch of us alternative managers saying, it's really annoying that we have to keep going to New York for all the good events. You know, why is all the action over there? California's, you know, the most populated state in the union. It's the 6th largest economy in the world. We have, you know, 30 some odd million people. We have some of the best investment minds, some of them, and more capital than almost any place in the entire country. Let's fix this. And so we got together literally with a piece of paper and a pen, wrote out some bylaws, came up with some general concepts, started reaching out to friends and passing the hat, and we launched the California Hedge Fund Association. 7 years later, we have over 1,200 members. We put on over a dozen events statewide each year in San Francisco, in Los Angeles, in San Diego, in Orange County. And even we now do an annual event in Las Vegas in conjunction with a lot of the events that happen there in the May timeframe. So it's really been a labor of love for us. And it's brought together not only asset managers, but investors and the people who service those asset managers. So accounting firms, law firms, custodians, trust companies, bankers, you name it. And people do a lot of great business through it. And it's been so successful that we are now going to pivot the organization in early 2017. And we are going to change the name to the California Alternative Funds Association, or CAFA. And in conjunction with that, we released this report just a few weeks ago, and I introduced it at an event we hosted in San Francisco. It's by a company called Preqin that does tremendous research on alternative investment. And what it does is really summarize the state of the alternative investment industry in California. And I'll just give you a couple quick facts and figures about it. And if you want a copy of it, I can send it to you by email, so just give me your card. But basically what it tells you is that here in California alone, almost 3/4 of $1 trillion is allocated to alternative investments. And when we say alternative investments, we mean hedge funds, real estate funds, private equity funds, fintech, venture capital, direct lending, things that aren't your traditional, I'm going to buy these stocks, I'm going to buy these bonds. Okay, so we're talking almost $1 trillion industry. There are over 1,000 active alternative investment managers here in California, and about 62% of all the institutional investors in California, and there's about 500 of them of size, are allocating to alternatives. So you can see alternatives have become big business here. But there's still opportunity. If only 62% are allocating, what does that mean? That means some are not, right? So there's opportunity for everyone in this room who's doing things that are not your vanilla, I'm gonna buy this stock and hold it, I'm gonna buy this bond and hold it. So that's why we're really excited. That's why we're expanding the mandate of California Hedge Fund Association to the California Alternative Funds Association, and why I'm really happy to be where I am at Sunrise Capital Partners. What I will tell you about Sunrise Capital Partners is that we are macro investors. So what we do is we're like the weathermen in finance, right? We're looking at the entire global climate. We're looking at currencies, commodities, stocks, bonds. We're looking at geopolitical events. We're looking at all the data that's out there and trying to figure out where things are going. What are the patterns? What are we seeing? And that's really what Rick invented in 1975, and that's what we continue to do. Now we do it in a lot of different ways. We have a flagship hedge fund. The thing Rick started is still going. It's basically has almost a 42-year track record. And when this camera goes off, I can give you figures and tell you what those are. Regulatorily speaking, I can't have posted on the internet my comments about performance. But there's a reason we've been in business so long. Okay, you can guess what that is. But what we've tried to do in the last 5 years is take the concepts from that tremendously successful macro investing strategy and apply them in other ways so that more people can get access to it. Because the challenging thing with a hedge fund is there's a lot of restrictions as to who can come in. We can only talk to certain types of investors. Those investors can only invest certain minimum amounts of capital, which are very large, and leave most people out. And when I joined the business 8 years ago, it never made sense to me. Why strategies this helpful and good can no one get to? It makes no sense. Why should these be only for these certain types of investors? So the last 5 years, we've done what a lot of you folks in the direct lending business are doing. We've democratized it. We've taken pieces of that hedge fund and we've built out strategies that everyone can invest in. So now we work with RIAs. A lot of our stuff is going to be planted inside of ETFs and mutual funds in the coming years. And we're doing everything we can to make sure that everyone gets a piece of kind of macro investing in their portfolio. And why would you want that in your portfolio? Because our type of investing generally tends to give you returns when you need them the most. Okay? When the cameras go off, we can talk a little bit about how we performed in 2008, for example. We were in the black in 2008, deeply in the black in 2008, when everything was going to hell in a handbag. A lot of our strategies might not make money in those crises, but they're designed to hurt you a lot less than the things like stocks and bonds that often can just go haywire on you in a crisis environment. So that's really what we're trying to do. We're trying to give people more robust portfolios. We're not saying give us all your money. Our thesis is give us some of your money. A lot of your money is at risk because it's in this single investment in stocks that when it's going great feels great, but when it's bad, it's really, really bad. So take some of those shillings off the table in stocks and put them in some other things. And that's really the whole point of the CAFA and the CHFA is trying to help investors diversify portfolios and come up with solutions so that they don't get hurt during the next crisis as much, and that they have more money in the game longer, because that's really the name of the game. The longer you can stay in, the better you're going to do. And the problem with these crises is they shake people's confidence and they shake them out. And the amount of cash that's still on the sidelines since 2008 because people just said never again is astounding if you look at the figures. And think about what that cash has missed out on over the last 7 or 8 years. So that's really the thesis of Sunrise Capital Partners. That's the thesis of CHFA and CAFA. And thank you for having me. I'm happy to talk about any of this stuff afterwards.